Hi, this is Alan Gassman. Welcome to the Business of Medicine, Legal Structures and Taxation. It is Saturday, January 6, 2024. I'm here with some of my best friends. They have a combined IQ of 300. It is Linda Diltz-Benson, an educator, an artist, and a Renaissance person, and Prikith Singh, one of the most prominent physicians in the United States, especially relating to his contribution to how to build an amazing medical team and an amazing medical practice and how to efficiently and effectively take care of patients and care about them. So welcome, Linda. Welcome, Dr. Singh. It's a great pleasure to have you here.
It's a pleasure to be here.
Thank you, Alan.
Now, before I forget, I want to mention your university. I don't have a lot of clients who started a university. The two of you have started a master's program university, which is really, really commendable. Do you want to tell us just a little bit about it, how it came about, in case I want to start my own university someday?
I'll let Dr. Singh talk about this.
Well, education is an integral part of healthcare, and our goal was always to keep our administrators, managers, and providers up to speed with the latest advances, latest technology developments in healthcare management. And we are very proud to say that we started an internal education program in compliance when it was not even a concept with CMS. So Linda actually is the one who started our compliance program in 2004, I believe. And it has kept us safe. If there is one thing that has held us together, it's this total culture of compliance that we have tried to bring in the company. And it is tough. It is one of the most difficult things to do, but we were able to do it. And then we said, let us spread this knowledge to others, because in master's programs, most of them are all theory. What we wanted to do was bring out the actual practice, how we have lived it and what we have done, so that people, when they get trained, they're able to make concrete changes, pragmatic interventions in the companies that they go to. And I think that is important. It is important for doctors, administrators, finance people, lawyers to get involved as much as possible in healthcare, so that not only can they protect their clients, they know the nuances and they can make their clients more successful. That was our thought, and I'm proud to say that it's already on. We have started, students have enrolled, and so far they've been happy with the content, unless they're just trying to make me happy by telling me that on my face.
The one that there are actually two master's programs currently available. And the one that Dr. Singh was discussing is the Master's in Healthcare Administration. And there it is, the top one, Ellen, the top one. Nope, that's the data science, which is the other one. That one.
Yep.
Is the one, that's that one. That's the one that we have students in right now. And I keep getting asked what makes us different from, say, one of the other big schools that are known throughout the country. And as Dr. Singh alluded to, we attempted to take theory and bring it right into a toolbox of metrics and things that could actually be put into practice within whatever healthcare entity the students are either working in or looking to work in. So it's very pragmatic, it's very hands-on, and the students seem to be enjoying it, so yay.
Okay, so let's go to our webinar here. And for those of us who don't have the time to enter into a Master's of Science of Healthcare program or data program, what would you read? What would you do to try to get as much experience and as many good ideas for your organization as possible, especially relating to the business of medicine?
What would you read? I have written my own little, blogs and created a primer in healthcare. If anyone wants it, I'll be happy to send it to you and you can forward it to them. We have done a book on compliance, a fun book of compliance, if that is possible.
Wow.
And also a fun book on MRA compliance. I know if Linda can have fun with compliance, then so can we. And that was the thought process. And she has written a great, trying to make compliance for dummies like me. And it is, I think it is enjoyable and it's funny and it's cute. So those are things. There are, of course, a lot of great books, but usually they are technical. We have tried to make it very simple and basic. And so far, I've had whoever has read it seems to like it because they can apply it.
Right. So that takes us, when I wrote a book on a physician's guide to Florida law and creditor protection, Dr. Singh wrote the preface for me. When I read it, I said, I'm not going to put this in the book because anyone who reads the preface is going to be disappointed in the book because the preface is so well written. So why don't you take the lead here and take us through your advice, which is really priceless and which I have shared with hundreds, if not thousands, of lawyers in courses that I teach.
So, Alan, the best part of it is most of it was learned from you. I'm just giving you your own lessons, which is the way I do things. But very briefly, this is more your wheelhouse, how to have legal structures and taxation. But I can give you from a physician's way to think. We have not been trained in this. What is the practical way to approach it? So I think the best thing, one thing your clients should know is to make sure the structure is right. Don't start something and then think of the structure. Think of the structure first and then create it. If you want to create a practice, I see so many physicians who are bare, who are totally vulnerable. Insurances are not in place, so structure has to be thought out. And I think this approach is still a good one. Do not mix entities, do not mix personal with business. We keep our real estate separate from our business, obviously because of the risk from malpractice in the medical side going to the real estate side, or vice versa, where you can have lawsuits from falls and all that. We try to keep each entity in real estate separate, and that has helped us a lot. Make sure you run each entity separate as if it were a separate person. Don't put your hands in the pockets of one entity to fill the pockets of the other. Make sure your documentation is clear. You create a strong compliance program. You not only create policies and procedures for your practices, but also make sure people live them, believe in them, create a culture of compliance. Remember, you are not just in a business. In medicine, practicing medicine, you're held to a higher standard, and that is the expectation of the society. You go in front of a jury, and now especially with those lawsuits that invoke the reptilian theory, where if the doctor is found to be even slightly deviant from the standards, especially in the ethical aspects or the compassion aspect, they can slap them with huge lawsuits, and we have seen them recently. A systematic approach is needed, as I've said already. Talk to your consultants, learn from them, talk to your peers, study and research, get some good consulting books. The best books to read are your consultants. Just talk to them and you'll learn so much. A good consultant is worth millions of dollars. That's my humble opinion. Hire the best people, because the best people will make sure that you end up in the right place. And I think, if you read the book Good to Great, that says the same thing. I agree with that. Constant training, iteration, because human beings will forget. You have to keep doing it again and again. And as I said, hire the best consultants. And they're not that expensive. Actually, they're the cheapest investment. A good consultant will save you so much trouble, even though they'll pull your hair, they'll make you pull your hair, but I tell you, they are your firewall. Get good insurance, good coverage. Don't mix your coverage. Don't buy cars in your medical practice or your real estate, because if you have an accident, it will hurt really bad. make sure they're separate, keep learning, make it a learning organization, and retirement is overrated. Remember that. My dad worked till 90, till the last few days, even in his, in the ICU bed, he was planning things for how we can educate people better in his next book. So don't retire, live long, keep learning, and that's the beauty of life. And if you protect yourself, then life becomes even more beautiful. Oh, there are more things. Okay,
Oh, yeah.
protect your license. I didn't even, sometimes I love to read myself. As Yogi Berra said, I never said the things I did. So protect your license, because that is your most important asset. We see this all the time, physicians getting in trouble. We just had a physician driving at 120 miles an hour on Highway 19. And oh my gosh, I was furious, and I read him the Riot Act, and I think he learned his lesson. Every person is a potential patient, but every patient is a potential lawsuit. So document. Make sure you're nice to people, not just because it's good business, but it's just a good life. Be nice to people, be harmonious, be kind, be gentle, be considerate. And if there are new things coming, be bold. Pick your partners very carefully. I can't overemphasize this. A good partner can make you fly, and a bad partner can bring you down to the dregs of the universe. So I think I'm just going to, time to start is now. That is the time you have to start fixing things. Don't be cheap, and be clear, and be honest, be upfront. Tell your consultants what your constraints are, because if you don't tell them, they can't help you.
How do you know if a consultant is a good consultant or maybe isn't going to be a good consultant? And I guess you're talking about lawyers, CPAs.
Lawyers, accountants. So background check is very good. Google is good, but they're all rigged nowadays. So your competitors, if they're good, they'll ruin your reputation. So if you're good, then you'll make sure that your star ratings is 5. That means you're good. You're paying attention to it. And talk to them. When you talk to them, if you're not learning every 2 minutes, that's not a good consultant. A good consultant is actually a good mentor and teacher, caring, compassionate, but tough. And I always think of a good consultant. Most accountants will not know him, but Marty Schweitzer, your neighbor, what a great accountant, what a great guy. Right to my face, he would tell me things. He would annoy the Jesus out of me for 30 seconds. And then I would appreciate how good and honest he was. And the last day, I still remember, the day before he passed away, he called his office, went over my accounts, made sure everything was filed correctly. And then that was his last discussion. So amazing, just meeting them, talking to them, meet a lot, but then pick the best and learn from them. Make them your teachers, make them your mentors. That's how I've approached it.
Personal referrals count more. I mean, if someone refers someone to you, this is the guy I used, I really liked him.
Yeah, a lot, very important. But always do your own background search. To talk, I think that's the best way. In 5 minutes, you will know who's a good consultant and who is not. That doesn't mean you shouldn't keep researching and learning. And a good consultant will tell you what he or she knows and does not know. So, and they will also get other consultants who are as good in certain fields that they're not in. Anyway, I think I've passed the baton to you, Alan, because you are the master in this. I will now let you talk, because this is your bailiwick, and I will listen. So thank you, and I appreciate you much, because you have helped save me so many times from trouble, and of course Linda, who is my firewall.
All right. We'll let you multitask. You can turn your camera off and
thank you. Yes.
Put your hat back on and your cigar back in your mouth, and have a great later in the morning. Linda, anything to add to that before we go into the, as we call it?
No, you, my dear, are the expert. We learned from you, and that's why you're one of the professors at Vetere. So take it away, Alan.
All right. And by the way, everybody has the ability to put questions in the question panel. Let me just go back to that in case you're not familiar with it. In the rectangle, the upside down pyramid, which says questions, you can click on that, and you can put in questions, and we'll read the questions and we will answer the questions. If I don't know the answers, I will make one up. So let's talk a little bit about taxation. At page 21, there are 4 different types of entities from a tax standpoint. And the first thing I'm going to say is a limited liability company can be taxed in any of these 4 ways. And regardless of how the entity is taxed, it will protect the owners from liability exposure. So I could set up a limited liability company and have it be disregarded for federal income tax purposes. That doesn't mean that it's going to be disregarded for state law creditor protection purposes. And a lot of CPAs and a few lawyers don't realize that. So I'm glad that you realize that now. The most popular type of LLC for a medical practice and for most medical businesses is the S corporation. And the S corporation usually does not pay any tax. It conducts business and it files a tax return called an 1120S. And the tax return says, "Dear IRS, here's all the company's income, here's all the company's deductions, and we're sending K1, K as in kangaroo, hop, 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 1, ONE, forms to the shareholders to let them know what their share of the income and deductions are." And everything has to be shared exactly pro rata. You can't say, "I'll take 30% of the income from the physical therapy, you take 20% of the income from physical therapy, but 80% of the MRI income." That may be legal, and we'll talk more about that, but you can't do that under an S corporation. And that's one of the problems we sometimes see. If you try to do that, then you can lose your S election. Another way to lose your S election is to have what is called an ineligible shareholder. So the S corporation can only be owned by people, charities, and certain trusts for people. And if you accidentally have the S corporation owned by an entity that's a partnership, or you have the S corporation owned by a C corporation, then you lose the S election. And it becomes, if you don't make the S election and you're treated as a corporation, then it is taxed as a C corporation. So on the left-hand side, you see the C corporation. Now, the C corporation is a separate taxable entity, and it files a tax return, and it pays taxes if it has income at the end of the year. And one big reason to use a C corporation is that it is only in the 21% federal income tax bracket until 2026, when the 2017 Tax Relief Act expires. So the 2017 Tax Relief Act, which was passed after Trump became president, lowered the income tax rate on C corporations. So I'm in the 37% bracket, let's say, and the C corporation is the 21% bracket. I can trap the income in that C corporation and defer the tax. But eventually, when the money comes out to me as a shareholder, as a dividend, I have to pay a second level of tax. So the tax could end up being more. In addition, the C corporation is subject to state income tax, the Florida 5.5% on average corporate tax, but that's deductible against the federal tax. The C corporation can write off medical insurance and medical expenses for its shareholders. The S corporation and the partnership cannot. I had a young married client who called me and said, I want to do a C corporation for my pain practice. And I said, no, you want to do an S corp? And he said, no, I'm going to have a very expensive fertilization process to have a baby. It's going to cost $150,000, and I can write all that off if I'm a C corp, but not if I'm an S corp. So I'm going to start as a C corp, and then I'll elect into S status later on after we've paid for all of this fertilization stuff. And now they have a beautiful baby and an S corp because they did make the S election. If you convert from a C corporation to an S corporation, then you have to take into account Internal Revenue Code section 1274, which says, wait a minute, you can't just convert from a C to an S. What about all those appreciated assets in there that we were going to tax someday? So you take a snapshot of the appreciated assets, and if you sell any of those appreciated assets, which include accounts receivable, if you collect on accounts receivable within 5 years of making the S election, from going from C Corp to S Corp, then you have a double tax. But there's a way around it. You declare a big bonus just before you make the election, and then you pay the bonus within 2.5 months of making the election. In the technical term, yada, yada, yada. There's a lot to know. I'm giving you background. An entity taxed as a partnership. Oh, by the way, Joe, can you email everyone the slides? Joe's going to email you the slides. I apologize that we forgot to do that. Okay. By the way, anything that goes well is I take credit for. Anything that doesn't go well, Joe takes credit for. That's why he gets paid more than me. All right. Partnership taxed entity. I can file an LLC and I can own 60% and you can own 40%, and we can conduct a medical practice. And then at the end of the year, the partnership files a form 1065, and there's a K1 to me and a K1 to you. And it's very similar to an S corporation, except number one, if you work there, you're subject to employment taxes, not a good thing. You probably avoid those with an S corporation. But number two, we don't have to allocate income exactly pro rata. So we could have a partnership that's an agreement that says Alan gets 60% of the MRI money, you get 40%, you get 60% of the PT profits, Alan gets 40%. So that's, but when you do that, when you allocate the income of a partnership other than pro rata to ownership, you have to obey the section 70, so the section 704B rules and the rules of substantial economic effect. You can't just willy-nilly say, well, you had losses this year, we'll give the income to you. Next year, I'll take the income. Oh, I need the depreciation more than you do. Those dogs don't hunt. So you have to be very careful in the partnership tax scenario. So how do you blend the fact that you want an S corporation to filter your income so you don't have to pay employment taxes on all your income, and you want a partnership so that you have flexibility? How can you have the best of both worlds? Well, stay tuned, and I will get you an answer to that as we build on this. I hope you find it to be interesting thing. I find it to be interesting. Now, the fourth category of an LLC is how you feel about some of your relatives. Disregarded. So if I own my own business, I could have a law practice in my name, Alan S. Gassman Law Practice. I wouldn't get anything done on my own without my team, but I could own it. And when I own it, it is reported on the Schedule C of my Form 1040 income tax return. And all my income on the Schedule C is subject to employment taxes. So not such a great thing. And we'll get more into that. But I could have an LLC taxed as a proprietorship. When you own your own business, it's called a proprietorship. And I can have the limited liability offered by the LLC. And it used to be we would never, ever recommend one of these LLCs disregarded, Schedule Cs, because the S corporation, as I said, would filter out the employment income. That has changed. Now, with an S corporation, if my S corporation has total income of $300,000 a year, I might take a $200,000 salary and then $100,000 dividend, and the dividend is not subject to the employment taxes or the Medicare taxes or workers' comp or unemployment compensation. But so in the past, we've normally wanted clients to take as much dividend as possible and as little in wages as possible. Now, the IRS, of course, has an opposite view. The IRS says, we want more wages. You're the one working there, you earned it. Well, no, it's not really just me. It's my nurses and my staff and my PT employees. I just take what I'm worth. The rest comes out as dividends. Well, something big happened in 2017, and that was the enactment of Internal Revenue Code Section 199A. They made it 199 capital A, and what it says is, if you are a medium income taxpayer and you have income from a business, then you can pay tax on 80% of the income. You get a 20% deduction. Now, if you're a high income taxpayer and it's a medical business or a law business or an accounting business, then you don't get the deduction. But part of the ownership of the business could be owned by your children, and you would be able to get the deduction. So for doctors who make $150,000, $250,000 a year, they may be better in a proprietorship now than in an S corporation because of the 20% Section 199A deduction. So let's see what's next here. I think I'll move to follow through with I'm going to skip around because I like to skip and hop. This is Marty's favorite medical practice structure. He taught it to me. Dr. Singh mentioned Marty Schweitzer, the CPA. Marty taught me this structure in 1988 or 1987 when I met Marty. And he said, look, set up a partnership of S corporations. Then you can allocate the income as you want to within the partnership tax rules and send the income up to a separate S corporation, each owned by each doctor. And back then in 1987, 1988, there was no such thing as an LLC that could be taxed as a partnership. There was only one state that had an LLC, and that was Wyoming. And then the corporations all had to be professional associations. In Florida, it's called PA, professional associations. In most states, it's called a PC, professional corporation. But he said that way, each doctor can get their distribution of profits. They can each have a separate accountant. They don't have to have the same accountant. They can each decide whether they want to put a car in their S corporation or not. It's not dangerous in the S corporation under a partnership of PAs structure here, because if your car's in the S corp, the only thing you're going to lose is the S corp, which you probably would have lost anyway. And each person can decide how much they want to spend on travel and entertainment, how much they want to give themselves as salary, how much they want to give themselves as dividends. So it's easier to buy into a partnership than it is to buy into a S corporation. So this is what a lot of small medical practices have. So let me look at questions here. Okay, thank you, Katie, for the questions. If a single member LLC, would you still recommend S Corp for a chiropractor? Well, that's a great question. If it's a single member LLC, if it's high income, I'm probably going to recommend S corporation. If it's medium income and the doctor's in a medium income tax bracket for Section 199A, then I'm going to recommend taxation as a partnership or as a proprietorship. Because that way you don't have to take salary, you can get the full 20% deduction on all of the income. Tyler, does 199A expire in 2026? Yes, it does. Thanks for reminding me of that. Samuel, can depreciation be allocated separately per partner? The answer is yes. If I'm the one who uses the MRI machine and I'm the one who put in the capital contribution to get the MRI machine, I think I can allocate the depreciation, maybe 99% to me, 1% to the other partner. But talk to somebody who understands partnership tax, and they have to be very smart to understand partnership tax, which reminds me of the definition of an actuary. An actuary, very, very smart in math, is someone who wanted to be an accountant but did not have the personality for it. Okay, so back to this roadshow. I want to show you the 199A rules, so I'm skipping around. So the deduction under 199A is provided for qualified business income, which is, sorry, hi Chrisanna, I'm giving a webinar, so I'll call you later. Thank you. Bye. Okay, does anyone know Christiana? She's really nice. She goes to Stetson Law School. Okay, so there's lots of definitions here, but there's two main rules. If the income comes from what they call a specified service, trade, or business, which includes a medical practice, then if you are single and over about 180,000 of income, or married and over about 350,000 of income, then you can't take the whole deduction. And if you have over about 280 in income, you can't take any deduction if you're single. If you're married and you have joint income of over about 450, you can't take the deduction. There's also a wage test for non-medical practices, but I'm not going to get into that much detail. On page 83, I've given you some of the phase-out numbers for how these rules work. But one thing that's interesting is that if you're in the 37% tax bracket and you have a child who is over 23, not subject to the kiddie tax, they're in a lower tax bracket, then you could save about $5,500. I mean, you could save a couple of $1,000s by giving that child income to soak up their bracket. Plus, they would get that 20% Section 199A deduction. So what we've done, here's a potential savings. If you're in the 37% bracket plus the 3.8% Medicare bracket or Medicare tax bracket, you're paying tax on 40.8%. If you could get that income to somebody who's single with $191,000 of income, and then they also get the 199A deduction that you would not have gotten, you're going to save $49,000 of tax per year per person. So if I have 3 daughters, I could set up 3 separate trusts called Section 678 trusts. The trust can be for my wife, Marcia, and our descendants, but each daughter could be considered to be the owner of one of these trusts. The K1 goes from the trust to the daughter. Then the money from the trust can go to the daughter to pay the tax, and the rest of the money can sit in that trust for the use of my spouse and descendants, saving $48,000 per person. So that tells you a little bit about, in fact, I've got some handy dandy charts here where you see a medical practice. This is a medical practice in a state that does not allow non-physicians to own medical practices. So what we do is the same thing that a lot of big companies do, is we set up a practice management company. The practice management company enters into a 20-year practice management agreement with the doctor owners. The doctor owners agree that the practice management company will provide the practice management to the practice, will employ the non-medical employees, and will receive compensation equal to 60% of what the bottom line income would have been after reasonable salaries to the doctors. Now, the practice management company has a net worth, and they can transfer ownership interests in the practice management company to these Section 678 trusts and reduce the income tax. And the practice management company may also own the accounts receivable, making it a little bit more difficult to have somebody reach those accounts receivable in the middle of a lawsuit. So let's see if there's any questions there. Nope. All right, so let me show you some other things. Another thing I want to show you, and of course I have enough slides here to teach a university master's degree course, which I did for Dr. Singh's university. This slide shows you, please keep the building separate. Why? Well, you know what? Every once in a while, I get a call that somebody's building caused a liability. She tripped in the parking lot and will never walk properly again. I don't know if I have enough insurance to handle that situation. So there's a building entity. Please don't put the building in personal names. Then there's your business, your medical entity. The medical practice can sign a 20-year lease with the building entity, and the rent can all come due if the building entity, if the medical practice ever becomes insolvent. So dear personal injury lawyer, take your best shot at us. If you get a judgment, 17 years of rent will be owed by the medical practice to the building entity, in addition to all of the debt that it already owes. Are you sure you don't want to just settle this lawsuit for policy limits? So just think about who is going to own what. All right, now I'm going to go back in time, back to when I was smarter and younger, not knowing that I wasn't younger or smarter. I'll show you some other things that are important. Here are the entities that can own S corporation stock. As I said before, most medical practices, the small ones and even some very, very large ones, are owned under S corporations. So here you have ABC Company, it's an S corporation. Who can own it? Well, the first thing that can own it, and by the way, I'm going to make a bigger cursor. Make a bigger cursor. There I go, big green cursor, bouncy ball. Isn't that neat? All right, so, oops, it disappeared. Let me get it back. All right, so So a grantor trust can own an S corporation. Now, in some states, a grantor trust cannot own a medical practice, but you could set up a separate management company. And if you want to do aggressive estate tax avoidance, there's different trusts that you can use to do that with a medical practice. Quite candidly, a lot of people do estate tax planning with all sorts of different assets, but not with the medical practice, which is the biggest income producer. You could have that income going to a trust that's never subject to estate tax using these techniques. Okay, an S corporation could be owned by an LLC that is owned by only one person for creditor protection purposes. So you have a doctor who resides in Nevada. She owns an interest in the S corporation. If she gets sued, the creditors may be able to take the S corporation. She forms a Nevada LLC. Nevada law says the judgment creditor of a Nevada LLC cannot take the LLC ownership. They have to wait to see if there's ever going to be a distribution, and then they get part of the distribution. She tells the creditor, I'm never going to make a distribution. Why would I give it to you? I'll just buy a restaurant in the LLC and have my family work there, and we'll lose all the money that way. Or she has that disregarded LLC owned 97% by her and 3% by an irrevocable trust for her children, which is also disregarded for income tax purposes to make it harder, or a Nevada asset protection trust. So there's things to be done, but you do have to do it carefully. A 501c3 charity can own part of an S corporation, but will pay tax on the income, maybe all of the income. So would be very careful there. And then there's something called a qualified subchapter S trust. And if you're going to die owning a medical practice, then your lawyer will know about what kind of trust can own the S corporation stock. So going back a little farther here, let us remember that we have not only federal income tax, but also state income tax. And some states don't have the S corporation income flow through. They tax it at the S corp level. But if you think you're paying a lot of federal taxes, how would you feel if you were in California paying 13.3%? If you sell your house in California at a gain, you're at the 33.3% bracket plus 3.8% Medicare. New York gets up to 10.9%. So they don't have Taxachusetts here. I thought that it would be here. But anyway, don't want to forget about those. All right. Let's go to the new parent F reorganization. Now, with a new parent F reorganization, I could have here eloquently referred to as the former PA, former professional association. This entity owned a medical practice and equipment and real estate. Yuck. So they went to their CPA and said, we realize we don't want to own the equipment and the real estate in this company because we want to get them out in case there's a malpractice suit or an employment suit. So the CPA said, I think there's a way, let me talk to a tax lawyer. And the tax lawyer said, yes, you can perform an F reorganization under Internal Revenue Code section 368A at 1F, as in Frank. And to be frank, I didn't know about this the first 10 years that I practiced, because when I took reorganizations in law school, the professor only got through 368A1G E. He never got to F. So all I do is I set up a new S corporation, creatively called New Holding LLC. It is owned by the same taxpayers who own the PA. They make the S election. Then we transfer the PA ownership to the holding company. First, under Florida law, we have to convert the PA to an LLC, because in Florida, PA can only be owned by a doctor or an osteopath, an MD or an osteopath. Those are both doctors, sorry. So now my holding S Corp owns my medical practice, and under the Section 368 regulations, the medical practice can keep its tax ID number. It will have to change its name from John Smith PA to John Smith LLC. It will have to tell Medicare it changed owners and it changed names, but that does not cause an interruption in payment. It will tell whoever else it needs to tell that this has happened. Now, once it's owned by the new holding company, it can transfer its assets to the new holding company tax-free, because the new subsidiary, the former PA, is what we call a Q sub, a qualified subchapter S subsidiary, or it can be disregarded. Either way, it can make transfers to the parent company. The parent company can set up sibling companies. What are sibling companies? Well, they used to be called brother-sister companies. Now I'm calling them sibling companies. It's a company that has common ownership. So they could put all the equipment into the equipment company. They could put the real estate into the real estate company. Then they could even set up a factoring company. So how would you protect your accounts receivable? You would take your accounts receivable and you would sell them to a separate company owned or funded by your family LLC. So here's how the economics work here. They have a family LLC. The family LLC loans $300,000 at 12% interest, not guaranteed, to the accounts receivable factoring company. The accounts receivable factoring company pays $300,000 to the PA for its accounts receivable. And then when the accounts receivable are collected, the money goes to the factoring company, and the factoring company continues to buy all the accounts receivable and to get all the money from collections. The factoring company charges the PA 2% of the value of the accounts receivable. So the factoring company has plenty of income, so it can afford to pay the 12% interest to the family LLC. The family LLC may be owned by the children. So now what happens below the parent company is not taxable. So what I mean by that is the parent company's tax return will show the normal income and expenses of the medical practice, but payments made by the PA to the factoring company are disregarded. Payments made by the factoring company to the family LLC, though, are legitimate interest payments, giving the PA a deduction, giving the holding company a deduction, and the income then goes to the children who are in lower tax brackets much of the time. So that is a better protected medical structure. Now, if the practice is a C corporation, you can do this same thing. You just set up the new holding company as a C corporation, and then you the subsidiaries of a C corporation file what's called a consolidated return until the C corporation decides to do something else. I had a slide for something I wanted to mention, but I'll just mention it without a slide as an aside. And that is, when a new client calls me and says, I want to set up an LLC for my medical practice, I say, are you ever going to bring in a partner? If the answer is no, I'm good with one LLC. If the answer is yes, I probably will, or I may bring in a partner, then I'm going to ask them to form two LLCs. One is an LLC that'll be an S corp, assuming they want an S corp. And then it will have a subsidiary LLC, which will be, as we call, disregarded. The subsidiary LLC will get the Medicare enrollment, accreditation, all that stuff. Tax ID number separate from the parent. So now when they bring in the new doctor sets up an S corp, and the S corp buys into the subsidiary LLC, which becomes taxed as a partnership. And now I have a partnership of PAs without having to instead have multiple member S corporation, which I prefer not to have. So here's another view. This is a common situation. We'll talk a little bit now about medical practice ownership. It depends what state you are in. In Florida, anyone and anything can own a medical practice. You could be serving life in prison for Medicare fraud, and you can own a medical practice in Florida. However, in Florida, if your medical practice bills and collects from Medicare or an insurance payer, if it's not owned by 100% by doctor, spouse of doctor, children of doctor, any other owners, then it has to register under the Clinic Act. And when it registers under the Clinic Act, it has to pay $2,000 a year. It has to be inspected. There has to be a medical director. You have to submit audited financial statements. It's a pain. So what we will commonly do then, if we're trying to get tax planning done, is let the doctor's spouse, the child be the owners, or use a management arrangement. Now, it is possible, and we have gotten informal approval from the Agency for Healthcare Administration to set up an irrevocable trust. That's not a person. But if the irrevocable trust only benefits this physician's spouse and children, not grandchildren, then that irrevocable trust could own a land trust, and the land trust could have the doctor as the trustee, and then the land trust owns the medical practice. And that has worked for our sophisticated estate tax and trust planning. But here you also see a trust for the children, which owns the building, which charges rent. So that takes you through that. So let's see, what can minor children own, 3 to 4 years old? Well, I think I would ask the Agency for Healthcare Administration if the doctor, as custodian under the Gift to Minors Act, could own that stock, but I never put anything in the name of a young person. What I do for a young person is set up an irrevocable trust. So that's what you can do for them. You set up an irrevocable trust. The irrevocable trust owns a simple land trust. The land trust has the doctor as trustee, and that's a good way to do it. By the way, I'm going to mention the kiddie tax. So the kiddie tax is a tax on children. And what it does is it taxes children at their parents' tax bracket if the child is under 23, I believe, 22, 23, unless once they're 23 or 24, they're no longer a full-time student, then they are taxed at their own brackets. There is a loophole around the kitty tax, and it has nothing to do with cats. It says that if the child provides 50% or more of their own support, that the kitty tax doesn't apply. So you set up a trust, and the trust gives the kid money, and the kid pays for more than 50% of their own support. That may work. Check it carefully, kick the tires, and blame someone else other than me if you try it and it doesn't work. But by the literal meaning of the Internal Revenue Code, it can work. And by the way, speaking of work, give the kid a job in your practice and pay them $6,500 a year. Make sure they've earned it, and then give them enough money that they can go set up their own Roth IRA. Because to have a Roth IRA, you need earnings of $6,500 a year. You put the money in the Roth IRA, it's never subject to income tax. $6,500 in a Roth IRA for a 16-year-old today, that's going to be hundreds of thousands of dollars when that 16-year-old retires in 60, 70 years. They can watch this video. That's where the idea came from. It's nothing I made up. All right. Now, I told the actuary joke, so now I have to applaud actuaries because I do. If I hadn't been a lawyer, I think I probably would have been an actuary. This is on page 27, your employee census. You put in this information: employee's name, date of birth, date of hire, date of termination, W-2 compensation, hours per week, ownership percentage. If they came to you and left and came back, you're supposed to give that information as well. So you give this census to an actuary, and this actuary then creates a computer printout after a little bit of work. You can't do this at home, showing you how much gets put away for the doctors and how much gets put away for the employees and whether it's worth doing. So here you have Charles and Ann Allen, and they're making $332,000 a year working in their practice, and you could go ahead and put $71,000 in for them, and then they have 4 staff members. They'd have to put in $10,000 for the staff members, and that's a pretty good deal, right? 80% for the doctors, or 90% for the doctors, 10% for the staff members, and if staff members leave before they're vested in 5 years, you get some of it back. That's a pretty good deal. But what I wanted to show you, and the slide is missing, is in this same situation, they could get like 95%, and Charles Allen could put away another 150,000 if they use a defined benefit plan or what they call a money purchase plan. And most financial advisors, especially brokerage firms and payroll companies, do not offer a defined benefit plan or a money purchase plan because they're complicated. So most actuaries who do pension work will run these numbers for you or for your client for free. And I am made to be a hero at least 6 times a year when clients are like, wow, Alan is so smart. I came to him for estate planning and I ended up with a $220,000 deduction. In fact, I had a client in 2023 who made $1 million contribution, $1 million exactly contribution to a defined benefit plan, and at the same time a $25,000 contribution for about 7 staff members who also got a nice 401k, by the way. So I'm going to end this session by thanking you sincerely for attending, thanking you sincerely, especially those of you who have attended prior webinars that I've given, for helping me be a better presenter and helping others, because that's what this is all about. If you have any further questions, comments, or suggestions, you can email me, agassman@gassmanpa.com. And now I want to play show and tell with you. And the program's over. You can't get credit for what I'm about to say. And this is shameless self-promotion, but it's free. So you go to your Google browser, and you can go ahead and do this now and put in estateview.net. ESTATEVIEW. Just do that, and then just click on go in. Click the blue button to go in. It automatically knows that your fake email address is test@test.com and that your password is test, TEST, all lower cap. So then Estate View comes up, and I'm just going to show you 3 features of Estate View that you may think are cool. Then I'll show you a last one. The first one is news. I don't know about you, but I do like to check the news periodically, and I'll have to check 3 to 4 different places. I like to see financial news, I like to see business news, I like to see world news. So I click on news, and I can pick 5 news stream feeds at once. The ones that we have on the software are here. You could pick any of them, and it'll show it to you. And then you can also get summaries. So now I can go ahead and quickly look at Bloomberg, look at Yahoo, look at Tax Advisor, look at Thomson Reuters, look at Tax Foundation. It will automatically update every 30 minutes, and there's a ticker tape across the bottom, and you can put this in as an icon on your computer. Just click one thing, and this automatically comes up just like that. So that's my first cool thing that Estate View does. The second thing that I want to show you that you can do with Estate View is you click on Life Insurance Estimator, put in the male or female, put in the age, and it will tell you how much per million you might expect to pay for life insurance. So let me go ahead and make this person younger. I'm sure they'll appreciate that. So here's somebody 53 years old, and per million, the multiplier goes to 1. Per million, if they're standard, they probably can't get 10-year, but they could get 20-year term, 40, I'm sorry, they can get 10-year. But anyway, that's the term cost, and if they wanted a lifetime universal policy. So when I'm doing estate planning and I want to know approximately how much something's going to cost, I can at least get an estimate. I don't sell life insurance, but at least I can give them an estimate of what's going on. The next thing I'll show you is the RMD calculator. So RMD stands for required minimum distributions that have to come out of an IRA. So here I have a 70-year-old on the left-hand side. We're going to go ahead and run this to age 95, let's say. So that's going to be 35 years. Their assets are going to grow at 7.5%. They're in the 37% tax bracket and not charitable at this time. So what I have here, oh, and by the way, how much is in there? They have $1 million. So what I can show here is that it knows that they'll start taking minimum distributions at age 73, and it shows the growth in the value of the assets. it shows the minimum distribution percentages, and then it shows the amounts that have to come out each year. It shows how much they're going to pay in taxes and how much they're going to have net. And as you can see, even at 104, there's still going to be a lot left in the pension plan. It doesn't run out. But maybe they're charitable. So I can click on advanced. Maybe they'll start putting 50,000 or 25,000 a year over to charity. So now it's showing that they could distribute 46,000 and pay tax of 17 and be left with 29. But instead, they'll distribute 25 to charity, 27 outside of charity, taxes lower, net amount, and in value. So at least you could show them how the minimum distribution works. Now, if they're younger, like if I click down to 60-year-old, you can see that the distributions don't start until a later year. So it knows the it knows what year you would start distributions. So that's the minimum distribution calculator. Then the next one, the Nest retirement calculator. This shows me a 40-year-old married to a 38-year-old across the top here, would like to retire at age 60, would die at age 85, has a home worth 750, investments worth $1 million, making 4.25 investment return, would like to retire on $100,000 a year, would like to leave $1.5 million on death for the children, inflation 3.75%, they're only saving $30,000 a year. They're way below. See that frowny face? They need to save another $95,000 a year or work until age 70. So that's the first one. Now, I can go ahead and just delete the others for now, just to show you how this works live. So here's all my inputs. And I can click on advanced and have even more inputs. So all the things that face a married couple. How much do you want to retire on at first? When you get older, you may need less. Are you adjusting for inflation? What's your home growing at? What are your investments going to grow at? How much are you able to save, which is very key? How much are you going to need to spend for a wedding, for a bar mitzvah? How much are you going to get in Social Security? It runs all these numbers and it gives you columns for everything. So nothing is not considered. And then it tells you, are you short? Are you long? How are you doing? And then you say, well, that's a good idea. What can we change? I can click duplicate. Then I've got number 2, which is exactly like number 1. But I can say, if you guys could save another $30,000 a year or another $70,000 a year, here's the result across the top. And by the way, if you die in any of these given years, here's how much life insurance we think you need to be able to have the survivor be on Easy Street. So go buy some life insurance. Here's a life insurance estimator button to tell you how much that might cost. So that is the Nest retirement calculator. The amortization program, you can now run an amortization table on without knowing any of the 4 principal items. So you can solve for the principal amount owed, you can solve for the interest rate, you just give it the principal amount, interest rate, number of payments, payment amount, payment frequency, and it will solve for the other item. It will also tell you the applicable federal rate, so you can use the lowest rate possible. Right now, it would be 4.49% for a loan of 9 years or longer. So you could just input the 4.49%, et cetera, et cetera. So that is the amortization calculator. And then I'll show you, just so you know, they have a qualified personal residence trust, the GRAT, the self-canceling installment note, but the charitable lead annuity trust, we have all that stuff. I'll finally just show you an estate plan. This is Bob and Mary Simple. Their various information is here that can be filled in. It takes maybe 15 minutes or 20 minutes to fill this in if you're going to do it carefully for a sophisticated married couple. That's down the left there. I can hide these things there. So and then on the right are my buttons. So in the middle, you see that they have 19 million of investments, 4.6 million residents. They're spending a lot. They're spending 550,000 a year. I'm gonna stop spending that much. So I'll reduce their spending, or their net spending. And just do that right there. Now they're just spending 200 a year more than they make. And then once they retire, they'll spend 275 a year more than they make. Let's do the same thing for the surviving spouse, so we can get some realistic numbers, because most people this wealthy are not spending as much. Okay, so 19 million of investments, $4.6 million residence, 3 life insurance policies, not in life insurance trusts. And if they die right now, there's no estate tax. They're under the limit. But what if they live 18 years? So I click on no planning, 18 years. And now you see on the first death, they'll have 43 million of investments. If the first spouse dies in year 17, $9 million residence. Second death on year 18, 5 million of federal estate tax, because inflation is going to cause the exemption to go up. So with a bypass trust on the first death that can benefit the surviving spouse without being subject to estate tax, they'll have a little bit less estate tax. But what if they put their home in a qualified personal residence trust? Click on personal residence trust. I'm not going to go into the details, but if they set up a personal residence trust, their estate tax will go lower. So let me change the settings a little bit here to help you enjoy this. I'm going to let the second spouse live longer. I like the second spouse. They seem very nice. So let's let them go to 2048. Now, if in 2048, you're still going to have a pretty large estate tax, but it could get worse. Let's play with one more thing. Will the exemption go down to half in 2026, which it is scheduled to do? So I'm going to have the exemption go down to 2026, and here I am. So the next thing they could do is they could gift annually for their children. And if they gift annually for their children, based upon just the $18,000 a year per child, which it now is, that will wipe out the estate tax, because that trust by the second death will have $14 million in it. But you know what? They may not want to do a bypass trust. And they may not want to do a Cupert, and they may not want to do annual gifting. So what else can they do? Well, now if they don't do any of that stuff, the estate tax is 8 million. So with a life insurance trust, I click on life insurance. Now the estate tax is 6.7 million. They could make a large gift and use up their exemption this year. And if they make a large gift of 4 million, then that will bring their estate tax down to 1.6 million. Or they may want to make a discounted large gift by gifting a family limited partnership interest. That could save them a little bit more. And then they could do an installment sale to a defective grantor trust, but let's say they don't want to do that either. The last thing they could do is just leave something to charity. So here, instead of $1.1 million estate tax and $78 million to charity, click on testamentary charity, and now you see that if they leave money to a conventional charity, $2.9 million goes to charity, but there's no estate tax. So let's watch that again. Either $77 million to the beneficiaries, $1.1 million to the estate tax, or $2.9 million to charity, $75 million to the beneficiaries, or they could form a charitable lead annuity trust, and assuming that 60% goes to charity, the children would get an extra $1,167,000 in year 19. So now what I can do is write them a letter about the estate plan. So I click on generate client letter. I click on select all scenarios. I click on generate client letter. Now it's going to talk while it's generating the client letter. It's going to explain a little bit about the letter. You can't hear it talk because for some reason Go to My PC doesn't do that. But it just prepared the letter. And there is the letter. It is a Word document, and it explains every step of the estate plan. So it explains all the inputs, and it explains, like I said, each step of the estate plan, including the charitable part at the end, which zeroes out the estate tax by using a charitable lead annuity trust. Okay, well, enough of the shameless self-promotion. As I said, if you want to use Estate View, it's completely free through April 1st, 2024, as we get the bugs out of it. And to get into Estate View, just go to estateview.link in your browser, not in your search, but your browser at the top. Go to estateview.link, and then just click on go in, basically. If it asks you for an email address, it's test@test.com. If it asks you for a password, it's test. Have a fantastic rest of your weekend. Thank you for inviting me into your home or onto your phone or to your office. I hope you'll share this with others. You'll get, in about 2.5 hours, you'll get an email with a copy of this webinar, and you can play it as many times as you like. Good luck, Mr. Phelps.